Okay, let's dive right into this explainer. I want you to think about your daily routine for just a second. We all have those tiny, almost invisible expenses, don't we? Maybe it's that quick stop for an overpriced coffee, the convenience of tapping a food delivery app, or even just dropping a few bucks on virtual stuff like Fortnite skins. In the moment, it feels like literally nothing. It's just pocket change. But what if I told you that redirecting just $5 a day from those fleeting purchases could be the actual foundation of life-changing wealth? Seriously. Today, we're going to break down exactly how that works. Just look at the math here because it is wild. If you take that exact same $5 a day and invest it, assuming a historical average annual return of 10%, over the course of 45 years, you aren't just saving money, you are literally building an empire. You would end up with nearly $1.6 million. I know, it's a massive, almost unbelievable number, but it perfectly illustrates the hidden magical power of time and compound interest.
But of course, whenever you talk about turning pocket change into millions, the skepticism rolls in, right? The investor who ran this experiment constantly heard three very specific hate comments. First, hey, I want to enjoy my money now, I don't want to sacrifice my youth. Second, I don't want to be a millionaire when I'm old and gray, I want it right now. And third, come on, what kind of investment actually gives these returns in the real world? Well, rather than just arguing back in the comments, these exact doubts inspired a one-year real-world proof-of-concept challenge, a true test to see if $5 a day actually works.
To make sure we have our topic and scene clear vision set for today, here is our roadmap. We're covering 1. The $5 challenge, 2. Picking the right platform, 3. Shielding money from taxes, 4. Automating dollar cost averaging, and 5. One-year results revealed. Let's get into it.
Starting right off with part 1, the $5 challenge.
So investing can seem incredibly intimidating if you've never done it before. It's kind of like a fog of complex terminology. But let's completely clear that fog right now. We can strip the entire process down to a simple 4-step framework. Ready? You find a platform, you open an account, you pick your investments, and you set up AutoInvest. That is literally it. This is the exact step-by-step framework used to set up the experiment we're tracking today.
Moving right along to part 2 on our agenda, picking the right platform.
Okay, the absolute most crucial point here is that not all platforms are created equal. You need some hard non-negotiables. First, low fees, so they don't eat up all your profits. It absolutely must have a beginner-friendly interface, high security, like FSCS protection in the UK, and low minimum deposits. But look at that very last point on the list, fractional shares. This is a real game changer. Think about it. A single share of a company like Apple could cost around $178. That breaks our $5 budget instantly. But with fractional shares, a platform like Trading 212, which is what they chose for this specific challenge, allows you to buy just a tiny $5 slice of Apple.
And that brings us to part 3, shielding your money from taxes.
This is arguably the most critical decision in your entire investing journey, because it dictates how much of your profit you actually get to keep. Imagine you have 2 boxes to store your wealth. Account A is a general investing account. If you put your money in there, the tax man is going to reach right in and take 10 to 20% of your capital gains and dividends. Ouch. But account B is a tax-advantaged account. It essentially puts an invisible protective shield around your money. Everything you grow inside account B is entirely yours to keep. Now, depending on where you live, this magical box goes by different names. In the UK, it's a Stocks and Shares ISA. Over in the US, it's a Roth IRA. If you have access to one of these tax-advantaged accounts, it is hands down the clear choice for maximizing your future wealth.
Let's transition into part 4, automating dollar cost averaging. You might be really tempted to take your $5 and bet it all on exciting single stocks like Amazon, Tesla, or Nvidia. But putting all your eggs into just a few baskets is incredibly risky. If they stumble, your whole portfolio just crashes. Instead, the strategy used in this challenge relies on what's called an index fund. Basically, an index fund holds shares from hundreds or even thousands of different companies all at once. For this experiment, a Vanguard S&P 500 index fund was selected. It tracks the top publicly traded companies in the US, which gives you instant diversification and dramatically lower risk.
Now, there is a tiny detail here that makes a massive difference. When you select an index fund, you'll usually see 2 versions, ACC for accumulation and DIST for distribution. Distribution pays the dividends out to you as cash. Sounds nice, right? But for this challenge, we want completely hands-off growth, so you must select accumulation. This ensures that any dividends those companies pay out are automatically reinvested straight back into your account, fueling that engine of compound interest without you having to lift a finger.
And now we arrive at the absolute secret weapon of this entire strategy: dollar cost averaging. I know, it sounds super complex and financial, but it simply means investing a fixed amount regularly. In our case, $5 a day. And you do this completely ignoring whether the stock market is currently crashing or skyrocketing.
So why is this so genius? Well, the stock market is highly unpredictable. It's completely driven by human emotion, mostly fear and greed. Dollar cost averaging removes your emotion entirely. Think about it. When the market is down and everyone else is panicking, your automatic $5 investment is actually buying more shares at a huge discount. Then when the market is up, your $5 buys fewer shares, sure, but the shares you already own have grown in value. Over time, these peaks and valleys balance out perfectly. It takes away the immense, stressful pressure of trying to perfectly time the market.
All right, the moment of truth, part 5, 1-year results revealed.
So the strategy is set, the automation's running in the background. What actually happened after more than a year of investing a mere $5 a day? Well, wealth building is rarely a straight line up. In month 1 of the experiment, things looked okay, sitting at a nice 1.5% profit. But check out month 2. The account dropped into the red with a 0.5% loss. Guys, this exact moment is where most beginners panic. They see their hard-earned consistency resulting in negative numbers, and they just pull their money out. But by trusting the system and just letting that auto-invest run, by month 6, the portfolio roared back to an 18.2% profit.
The absolutely crucial point to take away from this is how you handle the dip. Emotional fortitude is a literal requirement for investing. If you don't stick to the strategy when the numbers look bad, you are never going to be around to reap the rewards when the market inevitably turns around. The automation is the whole thing. It's what saves you from your own panic.
And wow, did that patience pay off in a way that is frankly staggering. Fast forward to 17 months into the challenge. Through consistent, daily, automated deposits, a total of £1,055, which is roughly $1,300, was invested. But because of the incredible growth of the market and the sheer power of dollar cost averaging, the account balance was sitting at £1,972. That is a massive 43.8% rate of return. No way, right? Now, quick caveat. It is super important to mention that this was a wild year for the stock market, and past performance doesn't guarantee future results. But honestly, it absolutely proves the incredible potential of this system.
This whole journey hits the nail on the head regarding the golden rule of investing. Time in the market beats timing the market. If this investor had tried to guess the perfect day to buy, or if they had stopped the challenge during that month 2 loss, they never would have seen a 43% gain. Small, consistent habits run over a long period of time will always outperform panicked, emotional decision-making.
We've seen the roadmap, we've walked through the mechanics, and we've seen the real-world proof of what just $5 a day can become. So I'm going to leave you with this one thought to mull over. You are going to spend $5 today on something. The question is, where is your $5 going today? Is it going towards some temporary convenience, or is it going towards your future? I really hope this